Holding the wrong asset long term can lose you millions off the return you could have gotten elsewhere holding the right asset. But so many people hold the wrong asset for years without going through the 3 steps that I'm about to share with you. So first step is, and we'll be talking about, will be comparing the right asset amongst other assets you have. The thought processes that I and other wealthy investors consider when identifying bad assets. And finally, the silver lining in taking into account those losses against potential future capital gains.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Let's start with comparing assets. Often people let ego get in the way of why they hold assets longer than they should. And you really need to start to compare assets in similar classes against each other. And that's really getting a fundamental understanding of other assets in the similar class. Now, I'll give you a really good example, and I'll share from some of my own experiences where I did sell properties at a loss to move forward and take advantage of other assets in other locations. But I'll give you some good examples to start with. If I look at a price for a property in that same location versus a similar price of a property in a different location, I'm going to start to look at the historical data and also talk to other people that have boots on the grounds to consider, have I actually purchased the right asset? What's the level of supply coming into the market? How long will this market continue to perform the way that it is? And what are the variable or fundamental changes to occur? Really good examples of this are potentially properties that you've purchased, say for argument's sake, like a unit, and there's thousands upon thousands of more units that are going to come onto the market in the foreseeable future. There could be development plans that have been approved, cranes in the sky, or properties near completion. What that does do is it does provide a lid on the amount of growth that your property will receive in the future, or potentially the rental income that you'll receive as well. I've seen this happen in vast amount of areas across many states in the country. It happens in Sydney quite frequently, and a lot of people have purchased, say for argument's sake, units in the region of Parramatta, which is one of Sydney's satellite cities. I've seen there's a lid on the prices of units there for a number of years. Again, in a lot of greenfield areas in the earlier years, potentially there might be a lid on prices as a lot more properties come onto the market. You need to understand what is going to lift that lid for allow prices to increase. So it's important to note that you need to get a fundamental breakdown of what's happening in the area, a fundamental breakdown of what's happening with other properties in the area, what's happening in the foreseeable future with more properties coming onto the market. For myself, I had properties that I'd purchased relatively quite cheap, and there was a number of these properties still transacting in the area. And this was in one of the regions of Queensland. I've held that property for 5 or 6 years, and it was costing me a substantial amount of money in repairs and maintenance per year. Tenant quality was quite poor, and I had my borrowing capacity tied up in this property for a number of years. I was unable to move forward, so I did have to make a decision to let go of this property moving forward. What was the couple of factors that rounded that decision to be made? I looked at other properties in that areas of similar condition and what they were doing, and I just had to make a decision. I had to say that that property, upon comparison, was not performing like it should. Now again, looking back in hindsight, yes, that property did grow, but I also got to factor in that where I moved that money and where that borrowing capacity allowed me to buy next, I actually had a substantial gain compared to if I was to hold that property longer term. So comparison is important. Look at assets like for like. And an example of it, if you've got shares in the banking sector, look at Commonwealth Bank shares compared to ANZ, compared to NAB, compared to Westpac/St. George. These are important things that you need to consider. Because if you've got shares in this sector and you've got maybe shares, for argument's sake, in NAB, but CBA has had a better historical performance and ultimately will perform much better in the future because you like their ideas, well then sometimes it's not necessarily a bad thing to say, well, hey, due to capital constraints, I don't have more money to put into Commonwealth Bank shares. I might just sell my shares, say for argument's sake, in NAB or Westpac, and I'll move them into Commonwealth Bank to get that next leg of growth. So it's important. Comparison is key. making sure that your money is moving in the market with the best possible return that you can achieve. You need to make sure you speak to your financial advisors, your accountants, or any other mentors or professionals within inside your network that you can chat with to get a well-rounded understanding of where to go. Because many people sit on the fence due to lack of information, due to lack of care and lack of time. Comparison is key. Ensure that your money is moving in the market in the best possible way that you can. Moving on to number 2, which is thought processes. What were some of the thought processes that I went through? Well, when I looked at my particular property that I had to move on at a loss, I looked at, well, what is the amount of money that I'm going to be sinking into the property in the future? At that stage, the property was negatively geared and it was probably only rented for about 65 to 70% of the time throughout the year. It generally did have anywhere between 20 to 30% vacancy at any particular time. I was struggling to keep a tenant purely due to the location and the poor quality of the property. Every year I seemed to sink thousands upon thousands of dollars into repairs, almost to the point where I felt that it would have been cheaper to knock the damn thing down and restart again. However, when I really reviewed those numbers and assessed it, I would have actually significantly lost money, because by the time I bought the property, knocked it down and rebuilt it and then sold it, actually probably would have been hundreds of thousands of dollars in the red. I got a quantity surveyor engaged at that particular time and I got them to review the entire condition of the property and provide me a report, a bit of a CapEx report. And what that means for people hearing that comment for the first time, a capital expenditure report. They showed me all the money that I need to spend on the property at certain periods of time. Now, I don't recommend everybody doing one. The cost at that particular stage was probably about $400 or $500. I'm not sure of the cost today, it could be a bit more. But that capital expenditure report they provided me said to me, Jeremy, over the next amount of years, and we're talking year 3 to year 4, year 5, year 6, year 7, we estimate that you're going to be spending this amount of money. And when I saw that cost being around about $80,000 over the next 6 years, I absolutely freaked out. Why? Because putting that amount of money, that $80,000 into this particular property, only a very small portion of it would have been value add. A large portion of that cost would have been for things that we assume a property has, and it does. Like, for instance, divert the water away from the eaves of the property into the dam downpipes. Or, for instance, the window frames, they were all rotted and wood, and to convert them to aluminium, again, people don't necessarily pay a lot more money and say, wow, we've seen the amount of money that you spent on converting your wooden window frames into now aluminium frames. In their thoughts, they just think, hey, it's a window. I open it when I want to let air in and I close it when I don't. And ideally, it keeps the water out of the house and as much sunlight in. So these were the costs that I was looking and staring down the barrel of, $80,000 over the next 6 years. And for me, that was a factor, a major factor as to why I sold that particular property. Because if I didn't, I would have had to spend that money over that duration of time, and I don't think necessarily I would have got that money back or a really good return. So what I looked at is I looked at the opportunity cost of having to spend that money, plus the opportunity cost of holding that property longer term with the negative gearing that I was facing. And I said, well, there's other opportunities out there by me getting back my capital, me getting back my borrowing capacity, and then pursuing other opportunities. So thought processes like that is what entered into my mind. When I'm looking at other properties that I'm buying or selling, I'm not really looking and saying, hey, it's a bad asset. I'm saying, hey, it's actually ran its course. So there's a number of properties that I've sold that have grown quite substantially in a very short period of time. I may have bought a property and it's grown by over 100% in 4 years, which means it's moved at 25% per annum. When I look at the reversion to the mean, now, again, that's properties then averaging out to follow its historical average of price increase, which could be anywhere between 4 to 6%. I'm looking at what will happen to this property in the longer term. It may stagnate, it may slightly decline. So if I've bought a property and it is well above now its historical mean of price increases, and it has a greater probability of coming back to its mean, its average, its historical average, otherwise known as coming back or reversion to the mean. That to me is a really good indicator to say, hey, this property is not necessarily bad, but it's ran its course. It's grown quite substantially. Now where can I put that money into another market where not necessarily I'll probably achieve 100% return in 4 years or 25% per annum, but I may achieve something that is more than the historical average. And that is all I'm after. If I can slightly beat the market, then I take that as a win. If fundamentally it's beat the market substantially and I believe there's more in it, or I believe it might have a reversion back to the mean, that is a big deciding factor of whether I keep that property or sell it. So this thought process I'm going through is not necessarily just for the bad investments in your portfolio, but it's also for the investments that may have ran its course and you foresee potentially a little bit of a slowdown to come. Now, if you're selling assets to buy Ferraris or Lamborghinis and you don't necessarily have a huge amount of income coming in from a cash cow like a business or a very high paying job, I do always recommend where you possibly can, talk to an advisor, speak to an accountant or property professional or investment professional and see where you can move that money into the next investment to achieve the next greatest level of return. A couple other things that come into my thought process when I'm looking at identifying properties as being bad investments is my ego. I hate losing. I hate losing money on investments and I always pride myself on making the right decisions. But sometimes, as investors, we need to swallow our pride. Sometimes we get it wrong. Sometimes the punt doesn't pay out. Doesn't pay the dividends or the bickies that we're after. So I think sometimes swallowing your ego and making sure that, hey, I'm doing this for bigger and better things is a very important process to understand, also a very important process to swallow. So putting your ego aside, making the decision and ultimately then saying, well, where can I recoup that in other areas or other investments? So ego, swallow it if you can. A couple of other thought processes that I go through is always looking at the economy. What's happening in the market? Where are interest rates heading? What's happening in this market from a supply perspective? What government potentially is coming in? Now, I don't let that become the overarching decision as to why I should sell that property, but it is something that I do fundamentally consider. Now, I'll give you a really good example. I did hold properties in Victoria many years ago. I held properties there from 2012 roughly through to about 2017-18. I did sell and make quite a bit of profit at that particular time. Now, the reason why I sold these particular properties was I was starting to see a huge amount of taxes come into the property market in Victoria. It was at the time prior to COVID, so it was while Victoria was going through a little bit of a green patch and prices were still increasing. But I did notice that from a state government perspective, the state government debt was increasing. I saw a number of rules and regulations being implemented into the market at that time, which was tenants having more control over landlords, processes around reviews and rental reviews, processes around smoke alarms, or if you had gas heaters, you needed to get them checked, I think once every 12 months at that particular stage. There was a lot of property taxes coming in. There was talk about land tax potentially changing. Lo and behold, it did. There was talk about vacancy taxes. There was talk about foreign income taxes as well for foreign investors. So there was a lot of things happening on a state government basis, which I didn't like. At that particular stage, I sold those particular properties and it turned out in hindsight to be the right decision. Why? Because if I held those properties throughout the last 6 years, they wouldn't have grown and I would have had a substantial amount of negative gearing creep into the portfolio during that stage, which actually would have had a negative impact on the amount of profit that I made. Why? Because I would have had a couple $100,000 gain on those particular properties, but it would have cost me $10,000 per year to keep those properties to receive the same gain 6 years later. So then my net gain wouldn't have been a couple $100,000, it may have only been 140. So it's important to identify what's happening on a state government basis and also federal government basis as well. Having a look at how that applies to your portfolio, whether it's in shares or properties, and then making a decision. Now, again, that decision needs to be backed up with where you're going to move your money next. So I'd never recommend, and no professional should ever recommend, that you should just sell for the sake of selling. There needs to be a plan of what you are doing. I'm moving money out of this particular asset and moving it into the next. So they're the thought processes that you need to make sure that you're looking at and identifying. One being an understanding of future costs or CapEx. Another one is reviewing where you'll be putting that money in the future, looking at state governments and federal governments are going to be doing as far as implementing new taxes, and really getting an understanding of what's happening in that market from an economy point of view. The last one is the silver lining. Now we've got to try to make lemonade from lemons. Nobody likes losing money. In my particular situation, when I lost a little bit of money on selling those couple of properties, I accompanied that loss with a profit from selling other investments. And in this particular example, it was selling some shares. I had some shares which did very well. I wasn't really fussed on holding them longer term. I wanted to get the capital out and the profit out of those shares that I held for quite a while. So what I did do was I accompanied that capital loss that I'd made from selling that property at a loss, and then offset that against the capital gain that I had from these shares that I'd held for a while. Now, again, the reason why I wanted to sell those shares is, yes, they may have had a lot more prospect for increase, and I believe they did, but I wanted the capital out. I wanted my original capital that I used when I invested in those shares, plus the growth that I made, and I wanted to offset the capital gain with that capital loss. Now, for anyone that's out there that's listening, when you make a loss on an investment, it doesn't form a deduction in your personal return or potentially trust or company that allows you to offset revenue gains, which means income that you earn from your employment or income you earn from your trust or company. But what it is a capital loss, which means that you can offset that capital loss against capital gains. And this is talking about investments or assets that are held on investment account, or otherwise known as capital count. That capital loss can be carried forward for a number of years, predominantly until the day that you die or the entity ceases. But ideally, to utilize those capital losses in a short period of time, you want to be trying to look at maybe utilizing capital gains against those capital losses. So in short, a capital loss that I made from selling those investments at a loss versus the capital gain that I made from selling some assets at a profit, I was able to utilize that profit against those losses and therefore able to pay the least amount of tax that I possibly could. So that's a little bit of a silver lining that you need to understand, that if you're having a bad investment, you've gone through the comparison process, you've gone through the thought process of making the decision to say, hey, swallowed my ego, done the comparison, looked at the CapEx report, not going to be moving because there's all these factors as to why it won't move. I'm going to be selling at a loss to get some capital back, get my borrowing capacity back for argument's sake if it's a property. And hey, I've got this other investment that I was thinking of offloading for a while. I'd like to get that capital back and maybe reduce the amount of capital gain tax that I'm going to pay by offsetting against the loss. And therefore now you've got a little bit more capital at your disposal to move into other markets. So if you've got that bad investment, make sure you're looking at those 3 steps. Identifying from a comparison point of view of that asset across other investments or other assets in similar markets, and what's the performance compared to them and yours. Going through the thought process, swallowing your ego, understanding CapEx, looking at what money needs to be spent on that property and if there's any value adding that you're doing. And then lastly, if I'm thinking about making this particular loss, how can I have a little bit of silver lining to losing money, and how can I maybe offset against that against future capital gains? I think if you can look at those 3 steps accompanied by speaking with good financial planners, good accountants, solicitors or other advisors, then you can start your progress moving forward in other areas, in other investments, and ideally and hopefully have stronger returns for a longer period of time. I hope you've taken a huge amount out of this particular episode. There's a lot of golden goodies there to really make sure that you're progressing and always moving forward your investment journey. No one ever makes perfect decisions all the time. Sometimes you bite the bullet and swallow the pill and move on. But if there's some silver lining there that you can gain, without a doubt, try to achieve it. I'm Jeremy Iannuzzelli. Don't forget to hit that like and subscribe button if you're listening to us on YouTube. Follow us on Spotify and iTunes. This is what school should have taught you, and I look forward to seeing you next episode.